Well, the thing we're really focusing on is high interest rates because we haven't seen this level of rates in a long, long time. So the effect of those high interest rates on the portfolios that we're managing is probably the most important question. We had long ago settled the question of composition of that portfolio in terms of sectors, kinds of companies. All of them are private equity backed. Most of them have financial covenants. So the structuring of those portfolios has been pretty consistent. But now this interest rate environment is very different than what we've experienced historically, certainly from the period of 2010 to 2022 when the Fed started raising rates. So we have a lot of things that we think about, but that's probably number one on our list. Well, it's similar to that in the sense that as we look ahead for 2024, with the interest costs, interest burdens on companies for senior debt at about 12%, which is about double what it was a year and a half ago before the Fed started raising rates. So the impact of that, it's very positive for investors because private credit right now, senior debt, unlevered yields are 12%. And that's, again, almost double what it was a year and a half ago. So it's good news, bad news. Great news for investors. A little more challenging for borrowers who have seen their interest coverage shrink over that period of time. Now, in our case, we invest in defensive sectors. We invest in companies with high free cash flow margins. And so while those interest coverage cushions have shrunk, they're still comfortable, over 2 times, which has been very helpful for our overall health of our portfolio. And the other thing that's helpful is the sectors that we invest in have all shown really terrific growth, both in terms of revenues and cash flows. So we have something called the Griffin Index, which measures the health of the companies that are in our portfolio. And over the last year or so, that growth has been double digits, 12 to 14% in both revenues and cash flow. So there's no sign of a recession in our portfolio, and we think that kind of growth will help, to keep interest costs and that coverage at a healthy level. So we set up the whole concept of portfolio construction for Churchill back in 2006, when interest rates were similarly kind of high. They peaked in that period in the summer of 2007, before, of course, the 08-09 recession. And we knew at that time that it was important to have companies that were not going to be cyclical, that were not retail-oriented, heavy commodities, and anything related to something that would have more of an impact on consumers in a negative way if we had a recession. And so we focused on consumer services, healthcare, technology, software, logistics back then. And we haven't really changed our viewpoint. We did pretty well through the Great Recession. We did very well through COVID, which was obviously a much shorter period of dislocation. And during that period, which was only a few years ago, as you know, we really didn't have any defaults or losses related to COVID. And so that encouraged us that the model that we had set up a long time ago would still be valid going into whatever was going to come after that. And that current period, which we're calling the new paradigm in private credit, has been this higher for longer interest rate focus, which is probably the number one issue that all private credit managers are facing right now. Well, one of the things that has, I think, been very helpful to us as we've grown our platform, and we have, when you combine the senior and junior capital platforms at Churchill, close to $50 billion of capital with the ability to commit up to about $500 million per deal. So we're a pretty scaled platform with hundreds of institutional investors. One of the things that we realized is that the supply of information and back office staffing and systems is arithmetic, whereas the demand is geometric. And so one of the challenges that we have, given our growth, has been to keep up with that demand. And so the 2 areas that have shown the greatest growth in terms of our own hiring has been our sort of middle office and our back office. And that includes legal and investor relations and all those kinds of things, but also finance and ops and financial reporting to investors. And we continue to evolve and to use our fintech platforms in order to keep up with that demand. It's a continued challenge, and there's no end in sight in terms of our own growth. We are getting more sophisticated every day, and we're throwing a lot of very experienced people at that. But one of the other benefits is that we're owned by a $1 trillion global asset manager in the form of Nuveen, and being part of that parent company, which has probably $300 billion in alternatives. So we're part of a much greater, kind of global platform, and we can benefit from a lot of their scale. And as a company that's been around for 125 years, it's great to have that kind of depth of support from a parent company.